Ladies and gentlemen, it is Wednesday, March 25th, 2026, 6 p.m. Eastern Time, and I am looking at a crime scene. I am looking at the financial equivalent of a body on the floor of the COMEX trading pit, chalk outlines still warm. And nobody on CNBC, nobody on Bloomberg, nobody on Fox Business is going to tell you who pulled the trigger. Because the person who pulled the trigger is the same institution that signs their paychecks. I want you to understand something right now. What happened today in the silver market is not a rally. It is not a breakout. It is not a technical bounce off the $69 support from Monday. What happened today is a detonation. A carefully engineered, mathematically inevitable detonation that just set off the most dangerous chain reaction in the history of the modern commodities derivatives complex. Silver ripped past $73 today, $73.14 on the spot market as of 4:47 p.m. Eastern. Up $2.47 from yesterday's close of 70.13. Up $3.21 from Monday's 69.39. Up over $6 from last Thursday's 66.93 flash crash, that little engineered takedown they tried when they dumped it nearly $11 in a single session to shake you out. Remember that? Remember last Thursday when they smashed it from $77 down to 66.93 and every single pundit on financial television told you the silver rally was over? They told you it was done. They told you to take profits. They told you the top was in. And what happened? What happened in the 5 trading days since that coordinated takedown? It went from 66.93 to 73.14. That is a 9.3% recovery in 5 days. That is not a dead cat bounce. That is a market telling you, screaming at you, that the short side of this trade is broken. Structurally, mechanically, mathematically broken. But here is the part that nobody is telling you. Nobody. Not one single analyst on mainstream financial television. If you think today's rip past $73 was the end of the short squeeze, you do not understand how the options market dictates the price of silver. You do not understand the mechanical architecture of what just happened. Today's breakout was the detonator, the fuse, the match that just got dropped into a warehouse full of dynamite. The real bomb, the thermonuclear device sitting underneath the entire silver derivatives complex, has just been armed, and it is set to explode by Friday. Let me tell you exactly what happened at $73. By crossing that line, by allowing the spot price to settle above the $73 strike, the market just trapped Wall Street in what I call the gamma trap. There are billions of dollars, I am going to say that again, billions with a B, in call options across the April contract chain that just went in the money. Call options at the 65 strike. Call options at the 68 strike, call options at the 70 strike, call options at the 72 strike, all of them, every single one, just went deep in the money. And the market makers who sold those options, the banks, the bullion desks, the prime brokers at JP Morgan, at Goldman, at HSBC, they sold those contracts naked. They do not own the physical silver to back them up. They assumed, they gambled, they bet the house that silver would never, ever hold above 73. And now, with Friday's options expiration 48 hours away, their risk management algorithms, the same algorithms that run 93% of all COMEX trading volume, those algorithms are forcing these market makers to go into the open market right now, tonight, tomorrow morning, tomorrow afternoon, and aggressively buy silver to hedge their catastrophic gamma and delta exposure. They have to buy millions of ounces of silver that simply do not exist. Let me say that again because this is the most important sentence I have said on this channel in 2026. The market makers are being forced by their own risk computers to buy millions of ounces of silver that do not exist. The registered inventory at COMEX, the only silver that is actually available for delivery against these futures contracts, has fallen below 90 million ounces. Let me walk you through that number. In October of 2025, total COMEX silver inventory was 532 million ounces. 532 million. Today, total inventory sits at roughly 366 million ounces. That is a 166 million ounce decline, a 31% drawdown in 5 months. But here is where it gets truly criminal. Of that 366 million in total inventory, the registered silver, the metal that actually has a warrant attached, the metal that can actually be delivered, has collapsed to approximately 88 million ounces. 88 million ounces backing a paper market with open interest, representing over 230 million ounces of claims. The paper leverage ratio right now is 7.1 to 1. For every single ounce of real deliverable silver sitting in a COMEX vault, there are 7.1 ounces of paper promises. 7.1 paper claims on a single physical ounce. The The suits want me to tell you this is not financial advice. Of course it is not. It is a survival guide for a burning theater. Do your own research if you still trust the people who stole your purchasing power. I have been screaming about this since October, since COMEX registered silver peaked and started its descent. Since London lease rates spiked to 34.9% and the Japan Bullion Market Association reported intraday peaks touching 39.2%, 39% to borrow silver. Think about what that means. If it costs you 39% annually to borrow a commodity, that commodity is not available. It is a fiction. It is unobtainium. And I have been called a conspiracy theorist for pointing out publicly available COMEX warehouse data, for reading numbers off the CME's own website. That is where we are in 2026. Reading official exchange data makes you a conspiracy theorist. Well, here I am, reading the crime scene report while the body is still warm. Now listen, I need you to do something for me right now. I need you to smash that like button. I am not asking because I want internet points. I am asking because this video is going to get suppressed. You know it. I know it. Every single video I have put out this month about the COMEX drain, about the physical delivery surge, about the gamma exposure and the options chain, every one of them has been throttled. The 2026 shadow ban is real. The algorithm does not want you to see this analysis. The algorithm does not want retail investors understanding gamma mechanics. So smash the like right now. Do it before you forget, because your like is the only thing standing between this analysis and a digital graveyard. Now let me break down the brutal mechanics of what is about to happen between now and Friday. This is the part where Bloomberg will never take you. This is the PhD level options mechanics that the sell-side research desks understand, but will never, ever publish for retail consumption. Let me explain exactly how a gamma squeeze works, step by step, trade by trade. Because if you understand this mechanism, you understand why $80 silver by Friday is not a prediction. It is an equation. When you or an institution buys a call option on silver, you are buying the right, but not the obligation to purchase silver at a specific price, called the strike price, before a specific date, the expiration date. Simple enough, right? But somebody has to sell you that call option. Somebody has to take the other side. And that somebody is a market maker. The market maker's job is to provide liquidity. They sell you the option, collect the premium, and hedge their exposure by buying or selling the underlying asset, in this case silver futures or physical silver, to remain delta neutral. Delta is a Greek letter that measures how much the option price changes for every $1 move in the underlying asset. When silver was trading at $66.93 last Thursday after that engineered crash, the $73 call options had a very low delta, maybe 0.15, 0.20. That means for every call contract sold, the market maker only needed to own about 750 to 1,000 ounces of silver to hedge. That is manageable. That is comfortable. That is a position they can sleep through. But here is the trap. As the spot price of silver moves closer to, and then through the strike price, the delta of those options increases rapidly. At $73.14, a $73 call option now has a delta approaching 0.55, 0.60. That means for every single call contract, the market maker now needs to own approximately 2,750 to 3,000 ounces of silver to remain hedged. That is a 300% increase in the amount of silver they need to hold, and they need to acquire that silver immediately, not tomorrow, not next week, right now, because the clock is ticking toward Friday's expiration. But it gets worse, much worse, because the rate of change of delta is called gamma. Gamma measures how fast delta changes as the price moves. And here is the thermonuclear part. Gamma is at its highest, its most explosive, when the option is at the money, which means right now, today, this exact moment, the gamma on the $73 strike call options is at its absolute peak. Every single penny that silver moves above $73 forces the market makers to buy exponentially more silver, not linearly, exponentially. This is the doom loop. This is the self-fulfilling prophecy encoded in the mathematics of options pricing. Silver goes up, market makers must buy more silver to hedge, their buying pushes silver higher, which increases delta further, which forces more buying, which pushes the price higher still, which puts more options in the money, which increases open interest, which forces even more buying. This is not a theory. This is the Black-Scholes model executing in real time on the COMEX trading floor. This is how GameStop went from $20 to $483 in January of 2021. This is how Volkswagen briefly became the most valuable company on earth during the 2008 short squeeze. This is how silver went from $26 to $50 in 4 months in 1980. The gamma squeeze is the most powerful force in all of derivatives mathematics, and it just got triggered on the most physically constrained commodity on the planet. Let me put numbers on this. Let me do the math live because I want you to see this. I want you to see the math that is keeping market makers awake tonight. Let us say, conservatively, there are 40,000 call option contracts outstanding between the $65 and $75 strikes expiring this Friday. Each COMEX silver options contract represents 5,000 ounces. 40,000 contracts times 5,000 ounces equals 200 million ounces of notional exposure. 200 million ounces. But the market makers did not hedge 200 million ounces because when they sold those options, the delta was low. Let us say the average delta was 0.2 when they sold. That means they hedged approximately 40 million ounces, 20% of 200 million. But now, with silver above 73, the average delta has exploded to 0.55 or higher. That means they need to be hedged on approximately 110 million ounces. 110 million minus the 40 million they already own equals 70 million ounces of silver that market makers need to acquire in the next 48 hours. 70 million ounces. And the entire COMEX registered inventory, the only silver actually available for delivery, is 88 million ounces. They need to buy an amount equal to nearly 80% of the entire deliverable supply of the COMEX in 2 days. I break down these complex market maker hedging algorithms and gamma traps so you can see the mechanical forces driving the price before the rest of the market catches on. If this macroeconomic reality check gives you the ultimate edge heading into Friday, consider hitting that super thanks button below to support the channel. This is the content they do not want funded. This is the analysis that keeps disappearing from search results. Your support keeps the lights on in the archive. Now let me put this in historical context, because I promised you 3 examples and I am going to deliver. Let us talk about the mechanics of past gamma events and what they tell us about Friday. Example 1. GameStop, January 2021. What happened with GameStop was structurally identical to what is happening in silver right now. Retail investors on Wall Street Bets identified that Melvin Capital and other hedge funds were short over 140% of the float. They began buying call options en masse. As the stock price rose, market makers who had sold those calls needed to buy shares to delta hedge. The buying pushed the price higher, triggering more hedging, creating the exact doom loop I just described. GameStop went from $17.25 on January 4th to $483 on January 28th. That is a 2,700% gain in 24 days. The gamma squeeze accounted for the majority of that move. Not fundamentals, not technicals, pure options, mechanics. And what did the system do? They halted buying on Robinhood. They changed the rules mid-game. They committed what I believe was the most brazen act of market manipulation in the history of the United States securities market. And now, in 2026, the same mechanical setup is happening in silver. Except this time, the underlying asset is not a video game retailer with a dying business model. This time, the underlying asset is the most essential industrial metal on the planet, used in solar panels, electric vehicles, AI server infrastructure, and nuclear reactor control rods. And unlike GameStop shares, you cannot print more physical silver. The supply is finite. The mines produce a fixed amount per year. And the COMEX vaults are draining at a rate we have never seen before. Example 2. Volkswagen, October 2008. Porsche quietly accumulated a massive position in Volkswagen shares and options. When it was revealed, Porsche controlled 74% and the state of Lower Saxony held another 12%. Short sellers realized only 6% of shares were available to cover. The gamma squeeze sent Volkswagen from €200 to over 1,000 in 2 days, briefly making it the most valuable company on earth. Short sellers needed to buy. Market makers needed to buy. Nobody was selling. Price went vertical. Now apply that to silver. COMEX registered inventory is 88 million ounces. Open interest represents over 230 million ounces of paper claims. The COT report shows managed money is still massively short despite this rally. Shorts needing to cover plus market makers needing to delta hedge equals a two-front war on 88 million ounces. Example 3. The Hunt brothers, 1979 to 1980. Nelson Bunker Hunt and his brother William Herbert Hunt accumulated between 150 and 200 million ounces of silver between 1973 and 1980, roughly 1/3 of the world's deliverable supply. As they continued buying, the price of silver went from $6.08 in early 1979 to $50.35 on January 21, 1980. That is a 728% increase in 1 year. The reason it went that high was that the hunts were taking delivery. They were pulling real metal out of the system. And the market makers, the same market makers who had sold paper promises, could not cover. They could not find the silver. What did the system do? They changed the rules. COMEX implemented Silver Rule 7, which restricted trading to liquidation only. They literally banned buying to save the short sellers. In 2026, COMEX registered silver has declined over 80% from its 2021 peak. In January of this year alone, 49.4 million ounces were delivered. That is 7 times the January 2024 delivery amount. All of 2025 saw 474 million ounces delivered against 203 million the year before. And Sprott Physical Silver Trust doubled its capital raise to $2 billion in January, enough to buy 18 million ounces at then current prices, representing 16% of COMEX registered inventory in a single institutional move. The hunts needed to buy 150 million ounces to move the market from 6 to 50. Today, the market makers need to buy 70 million ounces to hedge their gamma exposure, and there are only 88 million in the vault. The math is worse now than it was in 1980. Let that sink in. Let me know in the comments below, do you understand the power of a gamma squeeze, or are you still relying on traditional technical chart analysis? Because I will tell you right now, if you are drawing trend lines and Fibonacci retracements on a silver chart without understanding the options mechanics underneath, you are driving blind. The options chain is the engine, the spot price is just the exhaust fume. Tell me in the comments what your local dealer is charging for physical silver today. Tell me the premium on a 2026 American Silver Eagle. Tell me the premium on a 100-ounce bar. I want to know what the real price of silver is, not the paper fiction on the COMEX screen. Because I can tell you right now, the disconnect between paper and physical is wider than it has been since the COVID dislocation of March 2020, and it is accelerating. Now let me tell you exactly what this mechanical buying loop guarantees for the next 48 hours, because this is the forecast that no one on Wall Street will publish, but the math makes inevitable. The gamma squeeze creates what I call a liquidity vacuum. As market makers aggressively bid up the price of silver to cover their naked options before Friday's expiration, they are going to consume all available sell-side liquidity in the order book. Every limit sell order at 74, 75, 76, 77, 78, every single one of them is going to get eaten alive by these algorithms. The algos do not care about price. They care about risk. They care about delta neutrality. They care about surviving Friday without a margin call that would make Lehman Brothers look like a parking ticket. And when the sell-side liquidity gets consumed, when there are no more willing sellers at those levels, the price does not crawl higher, it does not inch, it gaps, it jumps. It teleports from one level to the next because there is nothing in between. This is how you get $5, $6, $7 moves in a single session. This is how silver went from $66.93 last Thursday to $73.14 today. $6.20 in 5 sessions. And the gamma pressure was barely engaged at that point. Now, with the price above 73, with the gamma at its peak intensity, with 48 hours to expiration, the mathematical crosshairs point directly at the $80 level. Let me walk you through this. The open interest concentration in the options chain, based on the most recent data from the CME, shows massive call option open interest at the $75, $77.50, and $80 strikes. As the price approaches each of these levels, the gamma from those strikes kicks in, creating a cascading effect. It is like a series of tripwires. 73 was the first wire, and it just got tripped today. 75 is the second wire, and that is where the first major cluster of outstanding call open interest sits. When silver crosses 75, an enormous amount of additional gamma is released into the system, accelerating the forced buying. Then 77.50, another cluster, another wave of gamma, another acceleration. And then 80. $80 is where the largest single concentration of call open interest sits. It is the big magnet, the gravitational center of the options chain. The math says the price will be pulled toward that level like a ball bearing toward an electromagnet, because every inch of upward price movement releases more gamma energy that propels it even further. And here is the part that should terrify the short sellers. If silver actually reaches 80 and holds above it, even for an hour, the gamma cascade does not stop at 80. It reaches past 80 into the 82, 85, 87, 50 strikes, where there is more call open interest from speculative money that bought those as lottery tickets weeks ago. And those lottery tickets are about to hit. The chain reaction has no natural stopping point until the market makers have fully hedged their entire options book or until the exchange intervenes, which brings us right back to the Hunt brothers, right back to Silver Rule 7, right back to COMEX, changing the rules to save the institutions at the expense of the investor. This is the game. This is how it works. This is what they do not teach you in any finance textbook, and it is what I have been documenting on this channel for the last 3 years. Now let me address the elephant in the room, the geopolitical accelerant. Because the gamma squeeze is not happening in a vacuum. It is happening against the backdrop of the most dangerous geopolitical environment since the Cuban Missile Crisis, and every single one of these geopolitical events is adding rocket fuel to the precious metals complex. Gold is at $4,565 today. $4,565, up $181 from yesterday, up over $1,500 from this time last year. Gold futures opened at $4,473.50 this morning, already up 1.6% from Tuesday's close of $4,402. Gold hit $5,000 in the January parabolic before the correction. It is down 13.4% over the past month because of the Iran situation, because the war has created an oil price spike with Brent above 100, which has spooked the inflation hawks at the Fed, which has created uncertainty about rate policy. But today, gold ripped higher on reports that Trump claimed the U.S. and Iran are negotiating a peace deal. Iran denies it. Attacks are ongoing. Sources say the U.S. is deploying more troops to the Middle East. The Strait of Hormuz, through which 20% of the world's oil flows, is under direct threat. And precious metals are catching a bid on any hint of de-escalation because de-escalation means lower oil, which means less inflation pressure, which means the Fed can cut, which means real interest rates go lower, which means the opportunity cost of holding gold and silver goes to zero. But forget the day-to-day headlines for a second. Let me zoom out. Let me show you the bigger picture that is driving the structural bid underneath precious metals in 2026. The U.S. Treasury, and this is not a conspiracy theory, this is from their own report, has effectively declared the United States insolvent. I am not saying that. The Treasury Department's own accounting documents say that. The national debt has blown past $36 trillion. Annual interest payments on that debt now exceed $1 trillion. Let me repeat that. The United States government is paying more than $1 trillion per year just to service the interest on its existing debt. That is more than the entire defense budget. That is more than Medicare. That is more than Social Security disability. The interest alone exceeds the gross domestic product of all but about 12 countries on Earth. Now do the math with me. If you take the $36 trillion in national debt and divide it by the M2 money supply, which currently sits at approximately $21.5 trillion, you get a debt to M2 ratio of 1.67. That means for every dollar in the M2 money supply, there is $1.67 of federal debt. That ratio was 0.9 in 2000. It was 1.1 in 2008. It was 1.3 in 2020. And now it is 1.67. The trajectory is exponential. And the only way to service that debt without defaulting is to create more currency units, which devalues the purchasing power of every dollar you hold, which is the very definition of inflation, which is the very thing that drives people into hard assets like gold and silver. And this is where the BRICS angle becomes critical. Because while the United States is drowning in its own debt, the BRICS nations, Brazil, Russia, India, China, South Africa, and now the expanded BRICS Plus bloc that includes Saudi Arabia, the UAE, Ethiopia, Iran, and Egypt. These nations are actively building alternative payment systems outside of the SWIFT network. China's cross-border interbank payment system, CIPS, processed over $26 trillion in transactions last year. Russia and India are settling oil trades in rupees and rubles. The Shanghai Gold Exchange is pricing gold in yuan, and the premium on silver in Shanghai is running $10 per ounce above Western spot prices. $10 per ounce. JP Morgan has been shipping metal eastward at those premiums, and the buyers in Asia are absorbing both the premium and the VAT tax willingly, repeatedly, because they value the physical bar more than any paper substitute. China reclassified silver as a strategic material in 2025. Read that sentence again. The world's largest industrial consumer of silver told the world that silver is no longer just a commodity. It is a strategic national security asset like rare earth elements, like lithium, like uranium. China restricted silver exports. This fragmented the global market overnight. It created a two-tier pricing system where Western paper prices trade at one level and Eastern physical prices trade at a significant premium. And that premium is the market's way of telling you that the paper price is a lie. The paper price is a fiction maintained by the COMEX derivatives complex, by the rehypothecation of silver that has been pledged and repledged and counterpledged across multiple institutions simultaneously. Rehypothecation, for those who are new to this channel, means that 1 bar of silver sitting in a vault is being used as collateral by 2, 3, 4, sometimes 7 different institutions at the same time. It is like selling 7 deeds to the same house. It works perfectly until more than one buyer shows up to claim the keys, and that is exactly what is happening right now. The buyers are showing up. The delivery demands are real. In January of 2026, 49.4 million ounces were stood for delivery at COMEX, 7 times the January 2024 figure. In the first week of January alone, 33.45 million ounces were physically withdrawn. That was 26% of registered inventory gone in 7 days. JP Morgan issued 99% of the delivery notices on one of those days, acting as the seller, the metal provider, and despite those deliveries, open interest in the contract increased by nearly 1,500 contracts the same day. New buyers were arriving faster than metal was clearing. The coverage ratio at COMEX right now is 14%. 14%. That means only 14% of outstanding paper claims can be satisfied with the current registered inventory. Anything below 15% is considered stress territory by the exchange's own metrics. We are in it. We are living in it. And the gamma squeeze that just got triggered today is about to pour gasoline on this stress. Now let me connect this to Basel III, or as the insiders call it, Basel IV. Under the original Basel III framework, allocated physical gold was reclassified as a Tier 1 asset with 0 risk weighting, equivalent to U.S. Treasuries. But unallocated gold and silver, meaning paper claims not backed by specific physical metal, received much higher risk weighting. This created an enormous incentive for banks to convert paper positions into physical. And that conversion process is exactly what has been driving the vault drain at COMEX and the LBMA for 2 years. The banks are not selling silver. They are converting paper into physical because regulators are forcing them to, and that regulatory-driven buying is happening on top of the options-driven gamma squeeze. Layer upon layer upon layer of buying pressure stacking on 88 million ounces. This is the liquidity cascade. This is the term I use on this channel to describe the moment when multiple independent sources of buying pressure converge on a single market simultaneously. You have the gamma squeeze forcing market makers to buy. You have the Basel IV reclassification forcing banks to buy. You have the BRICS nations and Asian central banks buying physical metal at $10 premiums. You have the Sprott Trust raising $2 billion to buy physical silver. You have retail investors stacking American Eagles and 100-ounce bars at premiums that would have been considered insane 2 years ago. You have solar panel manufacturers and EV companies competing for industrial supply. And you have an exchange, the COMEX, with 88 million registered ounces trying to satisfy all of these demands simultaneously. That is a force majeure event. That is the financial equivalent of every fire truck in the city being called to the same address at the same time and finding out there is no water in the hydrants. I will be tracking the options chain, the open interest, and the market maker liquidations every single hour as we approach Friday's expiration. Make sure you are subscribed to the channel with the bell notification turned on so you get my emergency alert the moment the gamma squeeze hits maximum velocity. I am not going to sugarcoat this. Friday could be the single most important trading day in the silver market since January 21st, 1980, when silver hit its all-time nominal high of $50.35 under the Hunt brothers squeeze. Except the Hunts were 2 brothers from Texas with inherited oil money. This time the buying pressure is coming from the combined weight of the global monetary system realigning in real time. This is not 2 billionaires. This is the mathematical consequence of $100 trillion in global debt meeting a finite supply of real money. So, let me talk about what this means for you. If you have been following my analysis all year, if you saw the January spike to 90, if you held through the correction and last Thursday's flash crash, you need to understand something fundamental. The paper price does not matter. What matters is physical possession. What matters is whether you hold real metal in your hands or in a vault you control with a specific bar number assigned to you. Because when this gamma squeeze detonates, when the options market burns, COMEX may do exactly what it did to the Hunts. They may halt trading. They may force cash settlement on open contracts at a price determined by the exchange, not the free market. If your silver exposure is in SLV or futures or unallocated pool accounts, you are going to get cash settled at whatever price the clearinghouse decides. But if you hold physical metal, nobody can force settle you. Nobody can confiscate your position. You are outside the blast radius holding the real thing while the paper burns. Now let me talk about the repo market because this is the plumbing nobody covers and it directly connects to silver. The overnight repo market is turning over approximately $6 trillion per day in 2026, nearly 30% of annual GDP turning over every single night. The stress in repo directly connects to metals because the same banks short silver on COMEX are using those short positions as collateral in repo agreements. When silver goes up, those shorts lose value, the collateral degrades, which triggers margin calls in repo, which forces banks to liquidate or post more collateral, which cascades across the entire financial system. This is how silver affects everything. An 88 million ounce vault in New York connects to the $6 trillion repo market, connects to treasuries, connects to the Fed's balance sheet, connects to the interest rate on your mortgage. It is all one system, and the gamma squeeze is pulling on a thread that unravels the whole tapestry. Let me also address the algo warfare that is going to intensify overnight and into tomorrow. 93% of COMEX trading volume is algorithmic. These are not human beings making decisions. These are programs executing preset rules at microsecond speeds. And right now, those algos are in conflict with each other. The gamma hedging algos at the banks are programmed to buy silver to maintain delta neutrality. But the spoofing algos, the algorithms that place fake orders on the bid and ask side to manipulate the price, those are trying to push the price back down to minimize the gamma exposure. You are going to see massive volatility in the overnight Globex session and into tomorrow's US trading. You are going to see $5 swings in minutes. You are going to see the price spike to 75 and then get smashed back to 72 and then rip back to 76. This is the war between the gamma hedging algos that need to buy and the suppression algos that need to sell. And I can tell you right now, historically, the gamma hedging algos always win in the last 48 hours before expiration. Always. Because gamma is not a choice. It is a mathematical obligation. The suppression algos can fight it for a few hours, but the gamma grows exponentially as expiration approaches. Every hour that ticks by makes the gamma stronger and the suppression weaker. It is an inevitable mathematical outcome. The only question is not whether silver reaches 80. The question is whether COMEX changes the rules before it gets there. And make sure you are following my secondary channel in the featured section. Click on it right now. We are hitting them from both sides. On the main channel, I cover the macro analysis, the big picture COMEX data, the options mechanics. On the secondary channel, I do real-time trade breakdowns, live chart analysis during market hours, and emergency alerts when the COMEX makes surprise announcements. You need both channels. You need the 30,000-foot strategic view and the ground-level tactical execution, because this market is moving too fast for weekly updates. We are in a war, and you need real-time intelligence. Let me wrap this up by stating the ultimate rule of derivative leverage. The rule that has been true since the first futures contract was written in ancient Mesopotamia and will be true until the last exchange closes its doors. The rule is this: you cannot create infinite paper claims on a finite physical asset and maintain that illusion forever. Eventually, someone asks for delivery. Eventually, enough someones ask for delivery that the vault runs dry. Eventually, the mathematical fiction collapses under the weight of physical reality. And when that happens, the price of the physical asset does not just go up, it goes to whatever price the last willing seller demands. And when there are no willing sellers, because every central bank is accumulating, because every solar panel factory is hoarding, because every stacker with a YouTube subscription is holding, then the price goes to infinity. Not in theory, in mathematics. They sold millions of paper promises they could not keep, and now the mathematical reaper has arrived. The gamma trap is closed. The countdown to Friday has begun. The market makers have 48 hours to buy 70 million ounces of silver that does not exist, from a vault that holds 88 million ounces that are already spoken for. This is not a prediction. This is an equation. This is Black-Scholes meets thermodynamics. You cannot create energy from nothing, and you cannot create silver from a printer. If you want to see exactly how my portfolio is positioned to profit from this algorithmic buying frenzy, if you want to know my exact allocation between physical metal, mining equities, and options positions, if you want the real-time alerts when I add to or trim a position, click the Join button and become an Insider member right now. The Insider tier gives you access to my private portfolio dashboard, my weekly options analysis, and my emergency trade alerts. This is the level of analysis that hedge funds charge $2.20 for. I charge a fraction of that because I believe this information should be accessible to every retail investor who is trying to navigate the most dangerous financial market in a generation. Click Join, become an insider. And I will see you in the members-only live stream tomorrow morning at 8 a.m. Eastern, 40 hours before expiration, when the gamma squeeze enters its terminal acceleration phase. This is John CC, the Currency Archive. March 25th, 2026, 6 p.m. Eastern, silver at 73.14 and climbing, gold at 45.65 and climbing, COMEX registered at 88 million and draining. The gamma trap is armed. The clock is ticking. And I will be here, documenting every ounce, every contract, every margin call until the last paper promise burns. Stay stacking. Stay sovereign. And I will see you tomorrow.